Hi, everyone. Welcome to the latest Carson's Take 5. Sonu, this week we're going to talk about no, the stock market is not rigged.
You think?
Yeah, there have been some well-known, I guess we'll call them bears out there that are just making excuses for things. And some have been saying the stock market is rigged. Some have been talking about a market crash literally for years. They're getting a lot of headlines and there's this big crash coming just like in the last week or two. But then you Google their name and they've literally, Sony, been saying the same thing for years. And yes, there have been periods where the market quote unquote crashes, but it always comes back. And these people just said the same thing forever. So I don't know, where do you want to start with this? On some of these perma bears or the rigged part? Where do you want to start?
Let's do both. I mean, when you think rigged, you think, oh, is it a bubble? Is it things like that? You and I have talked about it. Look, the last time we did this, we talked about the Dow being 40,000.
Yeah.
It doubled in about, 7 years? 7 years, right?
Mm-hmm.
The S&P's doubled in about 5-6 years, something like that. And, if it's one thing if it was all on the back of irrational exuberance or sentiment, but it's come on the back of earnings. It's come on the back of solid fundamentals, right? Over the last 30 years, rewind all the way back, after adjusting for inflation, stocks are up 7%. So that's 7% after adjusting for inflation, not 7% cumulative, 7% per year, I should say. But we've had so many bear markets. We've had the dot-com crash. We had the financial crisis. We had the pandemic bear market. We had the aggressive Federal Reserve bear market. 4 big bear markets. Stocks have done, stocks are pretty stable in the long run. I'll put it at that.
Well, no, they sure are. We've been talking for a long time in these Take Fives about why we thought the stock market should continue to do well. And literally just, earlier, like this week, late last week, we're hitting like all-time highs. The Dow just hit 40,000, like we talked about last week. And again, listen, there are periods of times when things are bubble. There are periods when trouble is coming. We still don't see that. And again, Sonu, I think it's such a great point. Earnings this year on the S&P are expected to grow about 11%. Start of the year, they were actually less than that. So earnings expectations have increased. Companies are saying positive things. Are there cracks out there? Of course, there are some cracks. There are some potential worries and concerns. There always are. But when we look at all the data and everything out there, we continue to see a strong economy led by a healthy consumer with potentially improving housing, improving manufacturing. Again, there's some potential issues out there. Rates are high. We understand maybe inflation comes back a little more. We don't expect that, but still there's always some worry. But just big picture, Sono, I think people need to remember the market usually goes up. One more thing from me, then I'll turn it over to you. One of the great things the average investor has in their back pocket is they're not managing money. We manage money. If we have a bad quarter or two, people aren't happy. There's pressure on us. We might make a bad investment decision. Your average investor, your average investor has time on their side because every year market's up maybe 71, 72% of the time. But if you hold longer periods, by the time you get to a decade out, 15 years, 20 years out, the returns are like always higher once you get out a couple decades. I know that's a long time, but average investors need to remember and remind themselves it's not about timing the market, but time in the market. So we've got about 90 seconds or so. What do you want to add to that?
I think it gets to another part of what you and I were talking about, the consumer, right? The consumer's mostly fine. If you look at consumer balance sheets, you're looking at assets and then liabilities. But I like something you mention often, which is denominator blindness. So you have to kind of normalize that, right? Because we know stock prices have been up. We literally said that it's close to about 100% over the last 5 years or so. And home prices are also up a lot, right? So asset prices are up, right? If you look at household balance sheets, assets are about 736% of disposable income. Right? Before the pandemic in 2019, it was 688% of disposable income, right? But then you take the other side. You ask, okay, what about liabilities? Well, liabilities haven't changed much relative to disposable income. It's still about 100% of disposable income. So net wealth has actually increased. And even if you look at income growth, right? And income growth adjusted for inflation, the Congressional Budget Office did this. They looked at a study in which, they looked at how much a consumption bundle in 2019, how much of your share of income you'd have to spend to buy that same consumption bundle. And that's gone down, that share of income required to buy that same basket of goods, that's gone down for every income group, right? What more can you say? I think everyone's come out ahead of inflation. Most people, I don't want to say everyone, most people.
Great points there. So, I mean, let's put a bow on this. We know there's $1 trillion in credit card debt. We know there's nearly $18 trillion of total household debt out there. But again, real incomes, net wealth, how much you have in the stock market, how much your house is worth, all of those things are up substantially as well. And in a lot of cases, a lot more than this record debt that we keep hearing about. So, all in all, are there worries? Of course there are worries. But when you hear the same loudmouth telling you there's some crash coming or that the stock market is rigged against a little guy, we would say take the other side of that. With all of that, everybody, this is, again, your latest Carson's Take 5. The stock market is not rigged. We'll see you next time. Take care.